the one thing that we've been talking about, the emerging market pullout, we were talking about this in First Word yesterday as well. It's not just an India-specific thing, everybody knows that, but the quantum of pullout in the last 4 or 5 days in India has been rather strong. FI sold about 2,000 crores in the cash markets yesterday as well. And that amounts to about 5,500 crores of crash markets selling on a provisional basis, which is not the greatest. CBOE VIX shot up in trade yesterday in the US too. And I was just checking, I mean, the CBOE VIX level day before yesterday and today. So if you take both of them into account, these are the highest levels that we've had since August 2015. These are substantially higher volatility levels for a market which everybody was saying doesn't have too much of volatility, so it'll be interesting.
All the volatility trades or volatility instruments that have, since then become very, very popular. I remember reading a Bloomberg story yesterday which suggested that, the ETNs or the, exchange traded sort of instruments, notes, products, ETPs amount to, just around the VIX and various versions of the VIX, amount to almost $2 trillion. So I suppose, all of this is sort of triggering reactions in the market across the board.
I'm guessing.
Let's starting with the
let's ask this to Andrew Ferris. He joins us on the phone line from Hong Kong. He's CEO at Ecognosis Advisory. Andrew, good morning. Thanks so much for joining in. 2 days, days of calm here and there, but there seems to be a definitive turmoil in the Dow, which is leading the other markets to come off. That the central bankers are hawkish is not helping matters.
Well, effectively, you're asking me what's going to happen next. I think the markets will continue to decline until, at the very least, the Dow Jones and the S&P are reasonably valued. And also, there is some perhaps clear sentiment that the Fed is not going to increase interest rates in March, although the Fed will continue to increase. Otherwise, there is absolutely nothing to be said. Look, everybody, including myself and my dog and my cat, have been expecting the markets to come down. I don't call it correction. I hate the word correction. There's nothing to correct. If the markets have corrected now, presumably now they are right, so we shouldn't worry. Previously they were wrong. The markets have fallen. Okay? And the markets will continue to fall until the valuations are sensible and reasonable. And not all the markets have been coming down. Okay. For example, the Kospi, to some extent the Taiwanese index, have been much less reluctant to take a big drop. The same thing with the SET index in Thailand. It's one of the very big markets, but it's not true that the whole of Asia is disappearing into a black hole. Of course, Hong Kong is being hit very hard and with a good reason, okay, because Hong Kong is very much on the line for higher interest rates with the peg, okay, the concerns that interest rates will continue to increase, as they will, and the fact that for 4 increases in interest rates that were reflected in Hong Kong interest rates did nothing to the stock market, well, now you have the accumulated result. All of it is utterly predictable, except, of course, for the timing. The causes behind it, any 101 economic student should be able to tell you that.
Andrew, fair enough. Good morning. We won't call it a correction. We stand corrected on that front. We'll call it a fall. But I think many people are correlating what's going on with equity markets globally to the yield movement, especially in the US, where we've seen the 10-year yield go all the way up to 2.8. And there is now talk that, around 3% is what potentially, the bond yield will settle at this year, maybe even higher than that. And whether that supports as high a price equity ratio right now in the US markets, that exists. So I'm just wondering, what is your position on how much more will we fall and where does India stand in all of this?
Well, let's start with India, actually, because poor old India, okay, the RBI refused to increase interest rates at their last meeting. But since July last year, the 10-year bond yield has gone up by 100 basis points. Okay, it has gone up by 100 basis points. In other words, the markets have been already taking this into account. And of course, the last Modi budget, which I'm afraid I'm not enamored with because it is a bigger fiscal deficit, which means that interest rates will increase even more in India. So the Sensex is going to come under pressure. We know that. It's nothing new. Look, since July, the interest rates, the long-term bond yields in India have been going up. And now, with the Modi budget, they will continue to go up even more. It is not a critique. It's just a reality. Okay, you cannot have bigger fiscal deficits and at the same time your long-term bond yields will be coming down. No, they won't. They will increase. And I'm not quite sure the extent to which the Reserve Bank of India may refuse to go just yet But clearly, the next move is not going to be a cut. The next move is going to be an increase in interest rates. So this is where India stands, and therefore the outlook for the Sensex is not bright, of course.
Well, Andrew, a few people may argue that the yields have already priced in hawkish tones in India for albeit different reasons, but they have moved up. Globally too, yields are at high levels. We are no longer at the 2.2, 2.3, 2.83 on last count. Another 10, 15, 20 basis points. Is that it? Or do the interest rate hikes which come in later on continue to spook the markets?
Well, the Fed has claimed it wants to call for another 3. Again, in other words, another 75 basis points, which doesn't appear to be a huge amount, particularly when, of course, the Fed started from effectively 0 interest rates. But if, let's say, we simply add another 50 basis points to the 10-year yields in the United States, you'll see that their prices will come down significantly more. The longer the yield, the longer the tenor, the more sensitive is the price to an increase in interest rates. So if you're telling me by how much more, I will hazard a guess of not less than 50 basis points from where we are now, the 10-year yield. Again, that, of course, will continue to be reflected back on what was already a significantly overpriced equity market.
So where do you expect, or how much further do you expect the Sensex/Nifty to fall, Andrew, here in India?
Oh, God.
Sorry to put you on the spot this morning.
I never avoid the awkward answers, and equally I'll stick my neck out. If we've seen a 2% fall at the beginning of the correction in inverted commas, then another 3% drop would be very much in the cards. Not necessarily at a single go. I think we are now in an area that it isn't, hey, we've come down by 5% and this is it. I wish it was as simple as that. But incidentally, before we go any further, the only absolutely brilliant thing which is happening is this drop in the equity markets is killing cryptocurrencies. And this is the best thing that has happened so far this year. As you appreciate, I'm not a friend of cryptocurrencies.
All right. Andrew, thank you so much for joining us this morning. That's a quick view on where India stands across the world when it comes to equity sell-off. Now,